All right, hey guys, this is Kevin, and this is video lesson number 3 inside of your calendar course where we are talking exclusively and only about calendar trades, um, calendar spread trades, horizontal spreads, time spreads, however you want to refer to them. Um, we're just spending several lessons here just having conversations about a calendar, how it can be traded, what your approach can be, and giving you as much information and content as I can possibly muster up so that you will be able to understand and have confidence trading a calendar to decide if that may or may not become your preferred vehicle. So, this video lesson, I will just continue talking somewhat about a delta neutral or non-directional type approach, but this video I am going to focus a little bit more heavily on a bullish approach, okay? Just to show you that there's not only one way to trade these types of spreads, okay? The PDF here on the main site is illustrating a calendar spread as a neutral defined risk trade created by selling near-term options, purchasing long-term, and this is the risk profile. So again, we're taking a non-directional approach, no opinion. We're going to say, you know what, I'm going to just follow the market, and I will let my risk management and my money management tell me how I'm going to, what kind of profits I'm going to make. Now, I'm going to shift the focus a little bit and show you one underlying asset. This is Domino's Pizza. It's a vehicle that is on one of the top 30 equities that I can highly endorse and recommend. That these are all very viable and valid candidates to buy and sell options on. There's plenty of liquidity. They have good charts, and they're a very good starting point without, getting down into the penny stocks or before you're ready to, maybe graduate to the indexes. Again, I'm going to just back up a second. When you are first starting out, please only stay in the ETFs. Those are the most liquid, penny-wide spreads, and you are not trying to really focus on making money. You're trying to focus on learning mechanics and understanding. All right, and these are the 4 major indices. SPY is obviously the first one I steer all students to. Now, equities will function just as well, but they will have their own unique personalities, and you will have to be ready to experience earnings events, news events, a little bit more sensitivity to geopolitical events, but the volatility will oftentimes play into your favor a little bit better in equities than some of the indexes or the ETFs. So for this video lesson, we're going to talk about Domino's Pizza. This is the price chart over the last year. But what I am going to do is I am going to come in a little bit different time frame because I want to illustrate what is one way and what is, a potential possibility for those of you who want to maybe take a bullish approach. And you'll see all of 2013, we had a little bit of a basing here, and then, we were just a pretty consistent uptrend for the whole year. We started out here at about 45. We ended the year at about 70. And so I think this is a very good time frame and horizon to just have more conversation and more discussion about calendars. And especially from a bullish perspective, I'll show you what happens when maybe a move like this occurs and you're right smack daddy in the middle of a trade, and something like this happens to you and you get a 10% correction here. What's the high there? 64.45, lows 58. So that's about a 10%, right? So how a trade, if you are leaning with a bullish posture into this kind of a move, and something like this happens, what's going to happen to your trade and the yearly performance? Okay, so that's where I'm kind of going with this video, and we'll just see how much time we get into, and if we're approaching 30, 40, 45 minutes and I've still got a couple of months, then maybe we'll only stay on that. If I end up getting through it in 10 or 15, 20 minutes, then maybe we'll look at another asset just to show something different. But again, for this video lesson, I'm going to just purposely just go from a bullish perspective to show you how a calendar can function and trade. All right, so we'll go here to the beginning of 2013. We'll just kind of roll to the end of the week here. And what I do want to say is, when I do my strategy development or my testing or my teaching, I am going to be showing at the end of the day. And the reason for that is the majority of my trade executions will occur at the end of the day, for a couple of reasons. I don't like to get whipped up in the frenzy of the first hour of trading. I very, very rarely, I have in the past, and I found that my performance really suffered when I would execute in the first hour or even in the mornings. Now I won't, that's not to say that I won't adjust or I won't open or close a trade in the mornings, but if I am starting new positions, I typically like to start them at the end of the day, not necessarily right at the close, but within the last hour of trading. All right, and it's just been my experience that those are better fill times. You have larger players or maybe even institutions rebalancing maybe portfolios. You might notice this a little bit more at the end of a week or at the end of a month or at the end of a quarter, at the end of a year. So just at the end of a session, whether that's a daily or weekly, monthly, whatever, you tend to see a little bit more activity in terms of volume, more activity in terms of fill prices happen a little bit easier. So that's what I like to do. So that's why, if you're curious why I'm showing here at the end of the day, that is specifically why. So the beginning of the year, we're saying we're going into the end of the first week. Domino's is at about $45. This is what we're coming off of. So looking at the prior week, we're coming off of the low of 28. At this point, I don't know if this was all-time highs or not. Looks like it might have been. So again, you may be taking a bearish position, you may be taking a delta neutral position, you may be taking a bullish position. For this example, for this video, we are going to take a bullish position for the whole year. And what I'm going to do is say, all right, if I have to choose between 15 days to expiration or 43 days to expiration or 71 days to expiration, what am I going to choose? Well, I'm going to choose the 43 days to expiration. And let's make this a little bit different so we see everything we want. And we're going to display 1-point strike intervals. Okay. Now, one of the very first things you should be noticing is, all right, well, but look at how much lower the volatility is on this front month than this back month, right? We have got 43 days to expiration. We've got 71 days to expiration. I just got done saying in prior videos, we always want to be selling front month equal or greater than the back month, okay? And so this looks like a terrible candidate. All right, well, that's a very good point, and we will see what ends up happening when we sell these terrible candidates. All right, and I want to show you how sometimes you can actually go against your rules and still make money. I don't want that to become the norm, but I do want to show you everything about calendars so that, as I've said before, and I will say it again in subsequent video lessons, you'll hear it again. I want to make sure that by the end of this course, you will know as much as humanly possible to get you started testing and trading these calendars. So right off the bat, this is not an ideal situation. All right off the bat, it's not. So I would have to ask myself, how strongly do I believe in Domino's Pizza continuing its bullish run when I'm going to be selling a much lower volatility than I'm buying? Well, all right, so I'm going to just say I'm going to come 2 points out of the money, all right? And I'm going to tell you why that's the approach. If I come right at the money, and that is a delta neutral trade, look at what the difference is. We are starting this trade entirely, completely underwater, right? This trade is going to be a huge loser unless we get a massive explosion here or a massive decline here. We're only selling this option for $1.44. We are buying this for $2.27. So if I come and I want you to notice this skew between the months, 20.6 and 26.5. That is the principal reason why your T+0 line is so far underwater. Okay? So what I want to do then is I want to delete this. Well, let's make sure we go into our model here, make sure slippage is none, commission's not included. And then I'm going to come just a couple of strikes out of the money, and I will say, all right, well, I'm going to sell this, and I'm going to buy this. The implied volatility difference is still there, and you are receiving even less credit for the higher strike price. You are in the calls, but again, we are saying we are taking a bullish posture. And what I want you to notice is this trade here that was right at the money, -1, +1, cost you $83. That's the net debit per contract. So sorry, turn that down there. That's the net debit. So you come out of the money, -1, +1, it's $78. The difference is very negligible, and you are taking a bullish approach instead of coming right at the money. So if you are wrong and it reverses against you, you have a less margin at risk. And the single biggest reason, difference between 144 and 55, difference between 227 and 133, this is what we're focusing on, the 47 strike price. So let's convert that trade, come into trade log, we'll give it, allocate it letter A, so that's the first cycle of the year, and this is the trade. So you will see, right, we have a trade that will lose pretty heavily if we begin any kind of a move down, but it will gain pretty heavily with any kind of a move up. The one of the biggest challenges with calendars is watching how this change across months in volatility influences these prices, and you will notice that as we continue going forward. So let's just say this is the approach. I've risked $78. I would like to lose no more than, we'll say $15. That's 20%, and I'd like to make 10. So I'm risking 15 to make 10, or even 8. It's 10%. Okay, so that's the approach. So let's just go forward a week. Let's go forward, 5 days in time. We'll see that Domino's really didn't move anywhere, right? I mean, we started back here on the 3rd, didn't really move anywhere, and yet what did we do? We gained pretty much all of our profit within that first week. We still have 36 days to expiration, and what I want you to notice is the front month option that we sold, We buy back for the exact same price. This did not change whatsoever. But look at what happened in this back month. What we purchased for 133, we now sell out for 145. This is where the profit is coming from. So this skew difference is very important, and that's why this front month being equal or greater than is what we are ideally searching for, but that does not mean that is the only time your calendars can make money. So we hit our target profit, we close our trade, right? That is the choice that you have to make. If that is the assumption, and we could, I could go back here and say, let's just look at, let's step through it one day at a time. What happened after the weekend? What happened after Monday? Well, you're only up $2, but it moved 18 cents. In order for you to hit your maximum loss of $15, we said, right? It'd have to move all the way down here, $43.92 from $45.50. So it'd have to move almost $2. Moved 18 cents. And if we wanted to, we could even look at the where's the average true range? What's the ATR on this? For the last 14 days is 88 cents. All right, so we could look at that to give us a little bit of a starting point if we wanted to, but didn't really do anything. So if this is your trade and you've position sized this accordingly to your account, this should not cause you any stress whatsoever, even though you're taking a bullish approach. Next day. Again, you're 10%. These function and operate no differently across all underlyings, but each underlying is going to have its own unique personality. And that's what's really relevant and really important for you guys to become aware of. So that when we look at this kind of a risk profile, we can see that we are heavily delta positive. So we don't want a move down. We want to move up. We want this to continue its upward climb, and at some point you have to agree, and you have to tell yourself, at some point I have to close this trade. And if you just are attempting to hold it until the very end, well, that's one way to trade it, but just accept that you're taking on a lot of extra risk and you are exposing yourself to a market that can go anywhere it wants to, right? I mean, it can go up, it can go down, but we picked a bullish direction. We made our 10%. We close our trade and we say, now I'm out of the market. I'm out of the market until I decide to get back in. I can get right back in at the exact same strike if I wanted to, or I can come right at the money. Let's just say, well, now that cycle is done. So we're going to say, you know what? March is 64 days away. I don't really want to enter one just right away. I want to go out of town for a weekend, whatever. So we'll just wait till the following. We'll go 2 weeks into the future. And we'll say now, March is at 50 days. What has volatility done? 30-day implied volatility, looking back at the prior year, is super, super low, right? So what do we want to do when volatility is super low? Do we want to open it closer to the 30-day mark, or do we want to open it farther to the 30-day mark? Okay, so if we want to open this closer to the 30-day mark, remember, let's just look at this right here. We'll go, actually, we need to go into here, just so you guys know where this is at, all right? Methods and strategies, calendar time, diagonal time spreads, it's right here. Okay, and so all right. Oh, you know what? Hang on 2 seconds here. This is not what I'm looking for. This is what I'm looking for right here. Where I was at already. We're right here, and we are in the calendar spread. That's what I was looking for. All right, entry consideration. So between 50 and 70 days when volatility is higher, 30 to 50 days when volatility is lower. All right, so when volatility is a little bit lower, we want to wait until we get a little bit closer to that 30-day to expiration. So we're just going to wait another week. Now at this point, you've closed one profitable trade, and you've been out of the market for 3 weeks. 3 weeks, right? Meanwhile, it's continued its bullish climb, and you are a bullish trader for this particular example. So we'll say, all right, well, I'm going to wait one more week. 4 weeks, haven't done anything, been out of the market. If you're out of the market can't hurt you, right? If you're out of the market, you can't make money though either. So you have to ask yourself those questions. But now, notice please, the implied volatility is 30.2 on the front month. The back month is 27.3, but that is June. We don't want to have that much distance separating. We want March and April. And so we need to bring in the April cycle. And we'll just reflash so that it brings over the prices. Oh, come on, don't do this now. All right, hold on 2 seconds here. Okay, well, I'm going to have to pause this and come back online just a second here because I'm trying to re-update all of these cycles, and for some reason it's not wanting to do it. So stand by. I'll be back in just a second. Okay, well, that was a big exercise in futility. So, let's just go ahead and, that's okay. Maybe there's a reason why things happen the way they do. So let's skip over April and we will say, all right, I think it might be happening because there are still 8 days to expiration on this one. We'll see after February expires if they're only letting me keep these open. I don't know why. None of these are coming in for this one other line. So we'll just roll with it, okay? So we'll come in here and you'll notice we have 30.8, we have 28.0. Again, we're going to come 2 points out of the money, and what I would really like you guys to focus on is trying to keep what you are selling as close to about $1 as possible, all right? We could come all the way out here and we could do this, right? We really could. That would be pointless because you're only selling $8 worth of premium on this front month, and while yes you could be making all the benefit from here, this is what your trade profile is going to look like. You're really, it has to be a really sharp, significant, steep climb. And again, remember our ATR here for the 14 days, 80 cents or something. So we really don't want to go too far away from it if we are taking a bullish position. So we'll say we're 2 strikes away. That's 36 days of expiration. That's plenty appropriate, and that particular trade's it's going to cost us about $127. Now I want to ask you, why is this one so much more than the other one? It's primarily because of this right here, your volatility. Okay, so this is the trade. We are a little bit bullish. This is what we are looking to capture. We are saying I convert the trade. I come in here, I assign it a new letter. It's a new cycle. And we say, all right, I'd like to make 12 and I'll give up 20 to do so. And again, we'll go forward a week at a time, 3 or 4 days at a time. We'll just kind of watch and see what ends up happening here. Well, now we're down 14. What happened here? Well, we dropped. We dropped down, volatility changed. This volatility increased, this volatility decreased, right? So we got a double whammy on both scenarios. Remember, let's go back and let's write down and let's look at exactly what the figures are. Right here, we have front month volatility at 30.2, back month volatility at 27.3. So we elevate on the front month from 30.2 to 31.6. The back month, we elevate from 27.3 to 27.5. I thought that we had decreased. But you'll notice that the increase is 0.2 as opposed to 1.4. So the loss that you are taking here, because your options that you sold, you're having to buy them back at a greater implied volatility, does not offset the loss of what these options decayed compared to what you purchased them. You bought these for $2.17. They're only valued at $1.58 at this point. All right, but you're not at your max loss yet. So what do? You don't close it. If you are saying I'm going to risk $18, we're hanging right on that edge. We're going into a weekend. Again, these are decisions that you will have to make for yourself. And if you're position sized appropriately, it might be, all right, well, I'm going to just let it go. Doesn't matter if my loss is 18 or if my loss is 20. If I am taking a bullish position and I am wanting a bullish move, okay, and I don't get it, well, at some point you have to say, we held its support here. Let's go back one day and see. You'll see that $14 is probably a little bit greater. Yeah, it's 25. So you have to ask yourself, are you okay with incurring a 2 times your max loss and you close it up on this day? Or are you prepared? Are you willing to say, it's only a $127 trade? Doesn't matter. I want to learn how this thing reacts and see where my true risk is. My true risk is only $127. It can go all the way to 0, and that's the most I'm going to lose. But if overall I have a bullish approach and a bullish mindset, well, let's go all the way to the week before expiration. As we've said many times, these markets, they come and they rotate. They box, they break out. They box, they break out. So if you are again, this is a personal style, personal preference. If you are going to say, I'm only targeting 10, therefore I don't want to lose any more than 15, well, the additional conversation is, well, if I'm going to let this go all the way to 127 and become 100% max loss, I need to target larger amounts, right? And so, again, it comes back to that trade management conversation. What's your risk to reward? If you are going to allow larger losses, you need to also be targeting larger gains. You cannot be going along for 6 consecutive months only making $10, $10, $10, $10, $10, $10, and then 1 month you lose 127. You'll never make it. You'll never, ever make it. So what I'm trying to show you is that if you decide at the beginning, I was only targeting 10 and I want to lose no more than 15 or even 20, if you hit that max loss, you have to close it. You absolutely have to close it and not let it go. But if you are going to say, this is only a $127 trade, therefore I need to make at least 127 or half of that, right? I mean, $10 profit $20 max loss still gives you the same parameters. If I'm risking the full 127, I better make at least 60, and as long as I do that more than, 8 times out of the year, this is going to be a successful strategy. Well, then that's what you have to do. So if this was the trade, we'll say, all right, well, now we've closed it. We've closed this one. We go into our trade log. It's already reconciled. And we say now April is coming up on 43 days expiration. Well, let's go 2 weeks into the future. See if April populates. And April still did not populate. So it's probably a problem with that data there. So May is 57, June is 92. Again, I'm not saying one way is better than the other. Let me back up and say you have to decide for yourself in the beginning which is going to be the approach you are going to adopt. Now, what I will say is if you are approaching it from the mindset that I'm willing to take a 100% maximum loss on the full margin amount because it's a directional bullish trade. Okay, well that's a very valid, viable approach. And you'll see that here we've got May and June. If I sell one and I buy one, I'm selling 25.6, I'm buying 25 even, I'm selling 53, I'm buying 90. It's a $30 trade. I'm not going to try and target $3 and lose 6 because of the slippage alone. So in this particular discussion, it's probably going to be, I'm not going to tell you what to do. I'll tell you what I would do. What I would do is I would say, all right, this is a $30 trade. I'm going to target at least making $20 or $30, and then I'm going to close it out. I don't care if this thing turns around and drops like a stone and gets all the way to $30 a share. I don't care. Then it's going to go in the loss column. But I'm not going to put such a short leash on a trade that it has such an insignificant amount of money attached to it. It's not going to work. But by doing these examples over and over again in paper money, in live money, with small amounts, in option view and backtester, I think you'll begin to discover what you like and what works for you. Again, the whole goal here is to help teach you how these options function and why the calendar trade is one way to participate in the options market. So these trades are converted. We've got 47 days to expiration. All we have to do, right, is between now and the next 47 days land anywhere between 51 and 58. If I wanted to turn off my computer for 2 weeks because I know it's a $30 trade, I can go 2 weeks. We'll go 2 weeks and 2 days. What is that $35 going to be worth to us at that point in time? It's $10. It's minus $10. All right, so it lost. It's outside of the tent, but there are still 31 days in which this trade can climb back within that range. So again, why close a trade when it is such a small, insignificant trade for this example? $30. So now you've made a 100% return on your investment. Okay. I have to be careful how I say this, but what I am going to say is I have seen too many times to count. It's nauseating. It's criminal. It is disgusting how many times traders on your internet are going to advertise ridiculous returns because they have layered out hundreds or perhaps thousands of trades, and they're going to cherry and handpick the ones that do this. All right? And you're going to see it, you're going to read about it, you're going to hear about it, 200% in 3 days of work utilizing options. There is so much blatant lying that goes on about options trading, and a little bit of deceit and a little bit of trickery and manipulating of some data is a very simple method to show customers and people who legitimately want to learn about options. Well, look, I only risked $200 and I made $25,000. It doesn't happen, you guys. So just to understand, if you accept how these things operate and see that yes, the potential is there to make 100% or more on an individual trade if it's taken in the proper context of your account size. This was a $30 trade that only made $30. The return on margin is, yes, that's 100%. But again, what did I took a bullish trade that had a bullish move, and I had to experience drawdown to get there. So I don't want to belabor that. I get a little bit I get a lot bit annoyed and irritated by it because people just really kind of steal money from people who really want to learn this. And the way it's done is just by using the complexity of options to say, well, you know what, it's really complicated and difficult, but let me just show you the easy way. Let me just show you how it works. And there are more moving parts to it, but it is not that complicated. It's very simple, and it all rotates back to money management and position management. So again, this trade, we still have 17 days left. Are we going to close it? Are we going to keep it? Are we going to get greedy? Are we going to try and pull the full 80 out of it? We risked 37. We're up 30. What do we do? All right, well, so let's say we just close it. We close it, and it's goes in the win column, and we call it a day. We're now up at $54 on Domino's. Remember, we started back here. We were at all-time highs, kind of went sideways, had a nice little move up, went sideways, nice little move up. Are we going to go sideways? Are we going to keep going up? I don't know. So let's just say, well, we're at 54.64. We can't trade the 60 strike just yet. I'll display all strikes and see if that lets me. Yeah, it does. But again, it's 18 cents, so there's really no reason to do that. So let's just go forward a week and a half. And we are already at 37 minutes. There's no way in the world I'm going to be able to get through anything more than what we're just talking about here. So we'll say, look, $58 is Domino's. We've got 43 days to expiration. We're skipping July and August. So let's just go another couple of weeks till once May gets out of the picture. Now we've got June, July. We've got 32 days to expiration. We've got 60 days. Do I want to sell 28 cents? -1, +1. I have another $47 trade that really needs a bullish move in the next 32 days. I don't know, maybe. You can pick that strike if you want. You can pick out the money. You can go in the money on the puts. In the money on the puts is going to give you ridiculous spreads, so I wouldn't recommend that. But again, we'll just convert that trade and we'll say, all right, now we're cycle number D. We've been in and out of the market various points in time. We're selling 19 implied volatility. We're buying 20.7. It's not equal to, it's not greater than, but it's about 2 points away, right? So let's just go for it. $45 trade. You're going to make $20, $30, $40. You're up 11. I mean, we had our directional move. We're centered within the tent. I mean, again, I can't tell you what to do. I can just show you how these respond and how they react. And my hope is that by the time you get through the end of the coursework and all of the video lessons, looking at bearish, looking at bullish, looking at what happens when it goes against you, that confidence grows because you notice, one of the biggest things that I talk about in the webinars, I talk about on all the tutorial lessons, this T+0 line changes shape as you get closer to expiration, so that at expiration, this is the shape. The farther in time you have, if this was 70 days instead of 10 days, this T+0 line would probably look about like this. Okay, very, 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 very flat. So the farther in time you get away from an option expiring, the flatter the T+0 line is. When we have low volatility and we are taking a directional trade, we sold it for 30 cents. We have to buy it back for 77 cents. That's a loss. That is a loss. But what we paid 75 cents for, we now collect $1.68 for it. That is the gain. The gain here offsets a loss here, puts $46 into our trading account. It's a 100% return on capital. If your capital is a 0.5%, a half of 1%, if it's 10%, I mean, you have to decide what that figure becomes on your account. This trade opened up on 5/21. It is now June 12th. There was nothing to do but watch this market. And that's why really options are not that sexy. They're not that appealing sometimes. They're boring. It's you have to be prepared to act when it's time to act, but the reality is you spend the majority of your time just waiting and watching. So when was that? Let me go here because I'll do one more example and then I'll close this one up because I think you get the point. I don't want to just waste your time. There was a day where we had a big drop down. I think it was the end of July. I'll just go into here. Because I do want to show you, yeah, right here. So what day was that? That was July 23rd. So let's go back here to, we'll just say the Friday before, big drop. And you're flat, you've got, perfect, 29 days expiration here, 64 days to expiration here. It's at $63. We will display 1 point strikes, large, large, large. All right. So we'll say if this is at, excuse me, I'm so very sorry. We'll say this is at $63.58. Here's our price chart. We're gonna go ahead and we're gonna target it all the way up to 65 or even to 70. We're gonna say, we're gonna target 70. It's a bullish calendar. We're selling 30.5. We're buying 25.8. I expect this is probably related to earnings. When you see really big increases in implied volatility, that is as earnings begin approaching. All right, so I expect that's what happened on the 23rd. I could go back and look, but I won't just for the sake of time right here. So this is a trade, right? You're risking $30. You've got the potential to make a pretty significant amount on this one because volatility is so high and you've got this large skew. So we've converted the trades. We'll go in here. We'll give this its own individual letter. And I'll explain to you why I do keep doing that in just a moment here. So we'll go to the 23rd, our $32 trade, again, which is yet another reason why I personally tend to trade. If I'm trading a directional trade using options, I am going to utilize, I'm going to position size it according to my account so that if it's a 100% loss, it falls within my trade plan. Because you'll see now we had this big move down. There's no way to defend against this. There is zero way to adjust your way out of this. Even if we went to the beginning of the day, the market just opened, and what do we have? We had a, minus $1 move here. We've already pretty much bit the bullet and realized a 50% loss, all right? And just as it goes in through the end of the day, that just continues to drop, all right, well, most option traders do not trade options because they want to sit in front of their computer all day intraday. You want to look at your computer, either quick snapshot in the morning, quick snapshot in the evening, every couple of days. So one way is just position size your margin accordingly so that a move like this, okay, man, didn't work. It was a directional trade. It hit my stop. Big deal. But what you gain by using options that you don't gain by utilizing directional currencies or futures is I can stay in this. I don't get stopped out. I still have 25 days for this to possibly reverse and come back into profit. I still have all of this profit left as potential at expiration. Remember, at expiration, it just has to close in between here and in between here. That's all it has to do. If it does that, I don't realize a 100% loss. I am taking a 100% drawdown on my margin right now. Okay, so that's super, super important to understand. I sold it for 38 cents. It's only worth 8 cents. I paid 70. It's only worth 15. And that's because I am getting, price is getting farther and farther away, making these options farther and farther out of the money. All right, so we'll go another week and a half. You guys know what's going to happen, right? I mean, it does. It comes back. So, but that's the point is, you still have time. And if you've adjusted it because you hit your max loss and it reverses and comes back and would have been a target profit winner, that's frustrating. It's frustrating, and it's avoidable by when you take, again, two different conversations happening right now. When you take a directional trade and you manage it 100% of a maximum loss, that's different than a non-directional trade where you're targeting max loss off of percentages of margin. So, and actually, I guess it didn't come back. I thought it did. I thought it came all the way back up on the 5th. Let's look at what happened on the 5th. But, all right, so it didn't come back up, and you know what? And we come into the next cycle. See how we got up to close to being $12. So we'll go this one right up to we've got 4 days. We'll go right here to right close to expiration. And it'll be, well, see, all right. So you've got 1 day to expiration, and you still have 50%. You don't have to realize a 100% loss. You have the chance, you have the potential of realizing less of a loss, even just that final day before expiration. I'm just going to go ahead and expire it. And then we will close that one. Which, you know what brings up, hang on a second. Oh man, we're 48 minutes, guys. I'm sorry. Well, so what? That's all right. I'm here for you. And so these are going to expire. I sold it for 38 cents. I'm not going to buy it back for a nickel. I'm just going to let it expire. All right. So it expires worthless. But I still have this in my toolbox, right? There is still time in this option. So this is what adds that further a little bit of complexity, but a little bit of opportunity with options. So this one's expired. This one's dead. My trade log says now it's expired. It has become a 100% loss on that 38 cents. But now, what do I have? I still have the potential, if it comes back, if it has to come back pretty hard, but if it comes back, I still have one long option there's really no reason for me to close this. What I can do, however, is I can go ahead and say, well, you know what, maybe I want to sell this one. Maybe I want to cap that because I think it's going to keep dropping, or I want to say, let me sell this one, turn it into a vertical credit or a debit spread. I've capped that, but I've created a little something different. Again, you have these choices when you trade options, but we're talking about calendars right now, so let's just stay in the calendar conversation. So we'll close that, convert that, and that is done. Now, the reason why I keep all these letters differently is then at the very end, I can go into my reports menu. I can say from when this trade started, if I allocate each one of these trade cycles, so meaning this one that I gave the letter A to, that was the first cycle. We opened them on the 4th, we closed it on the 11th. We opened it on the 8th, we closed it on the 8th. We opened it on the 1st, we closed it on the 1st. Now when I look at my report stock, I can see what my true P&L is per trade. I made 12, I made 88, I made 30, I made 46, I lost 12, and then I can begin calculating my returns based upon what my realized gains and losses are. If I do not do that, if I do not reconcile each one of these individual trades, then what it does is, unfortunately, it just gives me this whole big hodgepodge mess. Or I lied. Maybe it doesn't. You know what? Well, that is very interesting because that may be something that is now new. I'm still going to reconcile because when you start adjusting, it will not allocate the roll appropriately when you, if you don't reconcile each individual trade on this trade log. So for now, just understand that is why, and I will make sure in the next video lesson, video number 4, when we talk about bearish trades and how those react a little bit differently than the bullish trades, I'll show you what I mean by that when you make the adjustments. Okay, so guys, a little bit long, I apologize, 52 minutes, but I hope it was a good discussion. I hope you got some value out of it. I didn't get through the whole year. I did want to get through the whole entire 2013 for you guys, but I think you were able to see that, when something like this does happen, it doesn't mean that your trade is 100% fully over. All right, and the way that you can make sure is by just position sizing appropriately at the very beginning. All right, so thanks for listening. Next video lesson is coming up, and we will be talking about bearish calendar trades. All right, thanks guys.